Hello and welcome to the reading on equity valuation, applications and processes. This is an introductory reading. It gives an overview really of the processes we're going to look at, introduces the different types of valuation models that we'll study later on in the equity section. So without further ado, let's make a start. First slide gives us an overview really of what we're trying to do a lot of the time when we're valuing equity, and that's to get a potential mispricing that we hope will give us a potential positive return. A couple of definitions to look at. First one is intrinsic value. Intrinsic value is the true underlying value of a security given complete understanding. So to get to the true underlying value, we need a complete, perfect understanding of everything in the world. Clearly, the intrinsic value is completely hypothetical. The estimated value, VE, that's our estimate of intrinsic value, the investor's estimate of intrinsic value, and that's really what we'll be driving towards in a lot of our valuation models within equity. So we will come up with an intrinsic value based on our assumptions, based on the return we think shareholders require, based on the dividends that we think will be paid, based on the free cash flows that we expect will be generated, and so on. We'll use those to get our version of intrinsic value, and we'll compare that to the current price, the current quoted market price. And clearly what you're going to do as an analyst is say, right, well, I've come up with my estimate of intrinsic value, I've compared it to the price, that is the mispricing that I look at. However, there are two sources. And this is the one that's worrisome, the fact that your estimated intrinsic value is not the same as the true underlying value given complete understanding. So it'll be that plus the second part, which is the true mispricing. So just be aware, we call it the intrinsic value as if this is some sort of magical, definite, correct figure. That's only our version. We might not have it right. So once we've seen what we're going to try and drive at, how we're going to try and value equity, just a couple of concepts we should talk about, different valuation definitions. The first is a going concern value, which for the vast majority of this syllabus is what we'll be dealing with. Going concern means we're assuming that this publicly traded company will go on for the foreseeable future. Hence, we'll be looking at cash flows into the future from continuing operations and, for example, if we're using a PV valuation model, discounting those back to present value. That's as opposed to some sort of liquidation value, where we assume the business won't continue, they will cease to operate, in which case all of the assets are going to be sold off and the firm dissolved. In that case, we'll tend to value assets at what they can be sold for. So here's your list of assets, here's your list of liabilities. Let's just compare the two at the sale price. So it has implications for things like PPE. If we're looking at going concern in a set of accounts, we'll look at the PPE, we'll try and work out how much free cash flow will they generate. Liquidation value, they're not going to generate free cash flows by operating in the future. We'll just not want to know what we can sell them for today. Now, two types of liquidation here, liquidation value and an orderly liquidation value. Fact is, when most businesses dissolve and go into liquidation, it's because things are not going well. And the assets tend to have to be sold off to try and satisfy as many of the creditors as possible. And that's often referred to as a fire sale. Everybody knows you're in trouble, you have to sell the assets, and you tend to get a fairly low price. In an orderly liquidation, you have time to realize the full liquidation value. So you're not in a panic, not in a rush, not under pressure to sell. Theoretically, in an orderly liquidation, you should get a better price. Fair market value, over on the next slide, well, that's the price at which an arm's length transaction between willing and informed buyers and sellers should take place. Market price typically is the fair market value. Investment value, subtly different. That is the value to a specific buyer. So that's going to include the value of perceived synergies, pretty much what we'll look at if we're talking acquisitions. So look at somebody like Microsoft. If they see a really young, promising startup with really good technology they'd like to get hold of, that's pretty valuable to Microsoft for a couple of reasons. Maybe it fits in with what they're doing already. And secondly, it takes out a potential source of competition. So you have to look at the buyer and see specifically the value to them. So a few concepts to be aware of. Most of that early material really is just to learn and be able to quote to the examiner. We then have a list of uses of equity valuation. It's not an essay exam, as you know, it's multiple choice. So I think a question on this list will be fairly straightforward. Most of our focus throughout these readings will be on stock selection. So here's the current market price. Let's come up with an intrinsic value, our estimate of intrinsic value, and see if there's a potential mispricing. However, we will play around with a couple of these other things, including number 2, inferring inputs from the market versus history. Things like growth. We're trying to work out, given the current price of this stock, what growth rate is implied. So we'll pick a model that we think correctly values the stock. You may choose a constant growth free cash flow model. Work out, given the price, what the implied growth rate must be. We can also project the worth of company actions. So we're looking for acquisitions, for example, moving into a different area, buying an entire division. Is it worth it? What should you pay? Fairness opinions for mergers. 2 parties merging. Go to a third-party arbitrator, an investment bank, and say, right, give us what the correct transaction fee should be. Planning consulting to maximize shareholder value. Quite simply, when deciding on your business strategies, you have to try and work out what the value of each project will be. It's a method of communicating with investors, so laying out your strategic plans, what you think the value will be. Coming up with a value for a private business, we'll definitely have a look at that. And of course, portfolio management to try and find suitable stocks. Clearly, it's not an exhaustive list, but they are listed out in the reading, so be aware of each of those. Next up, industry analysis. The equity section is great in this syllabus. Obviously, it's a large part of your exam, but it builds up gradually quite nicely. We're starting here with defining what we're trying to do, the aim, which is to try and find mispricing. And then secondly, where do we start? Well, if you're ever going to come up with any kind of useful valuation, you have to start by understanding the industry and the company. And your starting point, your jumping off point, if you like, of industry analysis is often Porter's classic 5 forces. And there they are. 5 forces which you can look at, analyze, and use to decide upon the attractiveness of the industry. And when we talk about attractiveness, really what we mean is the ability of a company operating within that industry to maintain a competitive edge, to keep their profitability levels up. So of the 5, first one we look at, intra-industry rivalry, so within the industry, how rivalrous are the companies sat there? Obviously, the more rivalry there is, the more the companies are tempted to start to chip away at each other and engage in price wars and competitive behavior, the less desirable that industry is, the more difficult it will be long-term to maintain your profitability. If you have an industry that's very, very rapidly growing, well, companies will be so taken up trying to meet demand, they probably won't be attacking each other. If you have very few companies in the industry, that might bring down the level of rivalry. All these things that reduce rivalry will make the industry you're in more attractive. At the threat of new entrants, it's much easier to maintain your profitability long-term if you have barriers to entry. So high barriers to entry, maybe high setup costs, licenses, government rules, and so on, preventing anyone else from joining allows you to protect your profits. Availability of substitute products. Obviously, the fewer substitutes there are, the more difficult it is for people to switch away from your product. Therefore, easier it is to maintain your profitability. And then the power of both suppliers and buyers. kind of easy and intuitive to think about. You want the power of your suppliers and your buyers to be low. You don't want to be dictated to by your suppliers. So, for example, a pretty bad situation to be in is if you have one sole supplier of a raw material. They basically have you over a barrel and they can start charging what they like. If they don't have power, if you have a whole range of different suppliers you could go to, then again it's easier for you to keep your raw material prices down and your profitability up. Look at your huge grocery chains, buying in their fresh produce from small-scale farmers. Well, they can turn to any number of farmers to get their business. So you have no power over these big, gigantic grocery chains. Buyer power, same idea. You don't want your customers ganging up on you and forcing you to give them a good deal. Clearly, it's nice if you have super huge customers to do business with, but if you have a wide spread of customers, each individually with not much power, again, you can dictate prices, keep them high, and maintain your profitability. So your job as an analyst, first of all, analyze the industry. Why? Because you'll find how easy it is or how difficult it is to maintain those profits going forward. It will help you when you come to modeling your cash flows, your dividends, whatever valuation model you've chosen to use. Now, in addition to looking at Porter's 5 forces, he gets another look in. We can look at competitive strategies. So, as an analyst, how does the industry look? Look at 5 forces. Secondly, let's have a look at the strategy that this business has employed. And there's 3 to consider: cost leadership, differentiation, and focus. Third one, focus, is not too exciting. We can just say, look, out of the other 2, you can either have a very broad base, a very broad view, or you can narrow down and focus on just specific segments. But the first 2 are important to talk about. Differentiation, people tend to be happy with. You try and come up with a unique product or service. Make yours stand out from the crowd. Make it different, make it desirable. Look at Apple, for example. Cost leadership is the one that people sometimes kind of misinterpret. Strictly speaking, cost leadership simply means being the lowest cost producer. It doesn't mean offering a terrible product. Often that gets mixed up in people's minds. So to be a true cost leader, you produce a product that's just as good as your rivals, but you're able to do it at the lowest cost. Now, that's obviously great news for you because it means either you can charge the exact same price for the same product as your rivals, produce it at a lower cost, therefore make a bigger margin, or you are able, if you want to maintain the same margin, you're able to undercut them and charge a lower price and hopefully grow your market share. But be careful, cost leadership in this sense does not mean cutting your service down to the bare bones and giving a lower quality product. So we've analyzed the industry. We'll do a lot more on this as we go through the world of equity. And we've talked a little bit about strategies that are available. Then we need to look at the company itself and its financial statements. So we've looked at the industry, looked at their strategy. Now let's look at the quality of the financial statements that we have. After all, like it or not, the financial statements are a huge part of the information we're going to use to put together our valuation model. And you have to be careful. And you're well aware of this. If you look at the financial statements entire syllabus, you'll see lots of examples of this. But there's a nice summary here for us to use. So starting on the income statement, if you're picking figures from the income statement to try and model, let's say, future cash flows, look at their revenue and just look out for early revenue recognition. Remember, there are lots of different revenue recognition policies. You need to check that they're appropriate and they haven't taken in revenue too early. For example, way back from level 1, let's throw our mind back to percentage of completion versus completed contract. They may be inappropriately using percentage of completion. Slightly more straightforward, misclassification of non-operating income. You should not be including one-off non-operating gains within your top revenue line. So for example, Kaplan Schweizer, we're running CFA courses. Our revenue line should be from CFA courses. If we happen to sell off a spare warehouse at a profit, that should not be shown within revenue. It's a way of massaging the figures. In the expenses, the losses categories, look at your reserves. As you'll know if you've looked at any financial reporting or you can recall anything from level 1, you'll remember that there are lots of estimates as a result of our accruals-based accounting. Good example, let's say doubtful debt. If you've got a doubtful debt provision in your accounts, you'll set something aside to say, look, I'm owed $40 million from my customers. It's completely unrealistic to say I'm going to receive all 40 million, so typically, a portion of that you'll put to one side and recognize it as an expense and say, look, I'm unlikely to get everything back. But in any given year, if you're trying to massage your accounts, if you've got too much profit that you want to tuck away for future years, you may overstate that reserve, or if things are a little bit stretched this year, you may put too little in there. Lots of other examples. You can look at your valuation allowance on deferred tax, and so on. Inappropriate capitalization of expenses. Nobody likes it when you're inappropriate. Capitalizing expenses, what does that mean? Balance sheet instead of income statements. You spend $10 million repairing a roof. If it's simply a repair, that $10 million should reduce your profit before tax. Well, you might try and sneak it onto your balance sheet instead to boost assets. Then it will hit income statement, but it will only hit it over time as depreciation. And then the classic off-balance sheet financing where you understate liabilities. Everyone's favorite, the operating lease. Operating leases, anything you pay goes through as an expense. You don't see the liability on your balance sheet for what you owe. And operating cash flows may be artificially inflated by moving cash flows around in their classifications on the cash flow statement. So look out for that as well. So there's all sorts of things to be aware of. Brings a nice kind of financial reporting flavor to this early equity material. Next up, a nice summary of the different models we're going to meet along our equity journey. And first of all, two different categories, absolute and relevant. It's an absolute valuation model we'll use if we are trying to drive towards an intrinsic value, our estimate of the intrinsic value. It's based on fundamental characteristics, so we'll look at earnings per share, asset turnover ratios, leverage, return on equity, growth, and so on. We'll pick most of that from the financial statements, hence the need in the previous slides to be careful about what those financial statements are telling us and assess their quality. Examples, all three of which we will meet. Dividend discount models will get the present value of all future dividends. Free cash flow models will get the present value of all future free cash flows, be it free cash flow to the firm or equity. And residual income, where we'll take the current balance sheet value and add to that the present value of future residual income. Each is appropriate in different situations, each has their strengths, each has their weaknesses, which we'll discuss momentarily. Key point, they are all going to give you an absolute value, $28.14. Okay. Relative, slightly different. This is a value derived from a comparison to similar assets. Based on the law of one price, the example we'll see are our price multiples. So, price to earnings, price to book, price to cash flow, price to sales. We're looking at two assets, and I know this is theoretical and probably never going to actually happen, but imagine you've got two companies that are completely and utterly identical. The argument is, if they're identical, they should have the same PE ratio. So, I'll calculate an asset to compare to. I think that's the same as my company. If it's got a PE ratio of 12, well, I'm the same exact asset. I should have a PE ratio of 12. I should trade at 12 times my earnings. So I can look at my earnings, multiply by 12, and see if I am relatively over or undervalued using that comparison. All of those models we'll get to have a go at throughout these readings. Some of the parts valuations also worth a quick mention. Some of the parts means we look at a business and we value each division separately and add them all together to get the whole company value. And that exercise often throws up an interesting, I'm going to use the word anomaly, perhaps ill-advisedly, but I think it's fair enough. And that is the conglomerate discount, CD as we'll call it. Conglomerate discount is the sum of the parts value. So we're going to value each division separately. This conglomerate's got 5 different businesses. We value, let's say we use a free cash flow model. So we get the intrinsic value as the present value of the free cash flows generated by divisions 1, 2, 3, 4, and 5. You add all of those together, and guess what? You find that the sum of the parts value comes to 200 million. The market price is only 170. For some reason, there is a missing 30 million. The market appears to be applying a conglomerate discount. Why? Well, let's be brutally honest here. As with a lot of things in the mysterious world of equity valuation, we don't really know. But it's our job to suggest, so could be just internal capital inefficiency. A conglomerate with its finger in lots of different pies, lots of different businesses, isn't allocating their internal capital efficiently, isn't allocating its capital to the best investments, getting the best ROI. Or could be endogenous factors. So, fact is, this conglomerate is a conglomerate precisely because it doesn't really know what to do and doesn't really know what it does well. So you'll hear a lot of analysts say you end up as a conglomerate in 15 different completely separate businesses because you're not good at any of them. Or it could be, go back to slide number 1, quite simply a research measurement error. We said in slide number 1, the intrinsic value we get is our intrinsic value. So, is that 200 million right? Maybe not. Maybe the market's right. And we've simply come up with a measurement error. So, good little bit of chat on some of the parts valuation. How do you choose which valuation approach to use? Well, a couple of key points. Be consistent with the characteristics of the company. That's going to go back to our earlier chat on analyzing the industry, the company's strategy, what it does, and how its assets create value. For example, if every single asset this company has is a nice piece of brutal industrial machinery just generating product and cash flows, then great. Free cash flow model is going to be the best model to use. On the other hand, if this is a holding company that simply sits on land and waits for that land to go up in value, raw land, no rental income, just raw land, sits on raw land waiting for it to go up in value, then a free cash flow model is going to achieve nothing because we're not generating free cash flows. We have to take into account the quality and availability of data. If you don't know the dividends, a dividend valuation model, a dividend discount model is not going to work. PE models, price to earnings, they hit problems when earnings are very volatile. Earnings could go negative even. PE becomes fairly meaningless. And make sure it's consistent with the purpose of your analysis. So, we're trying to value this equity. Let's say, point number 1 from that earlier list, we are trying to value this equity because we're looking to buy shares in the stock. Well, are we looking to buy all shares in the stock, or at least a controlling interest? If we are, then really we should be looking at free cash flows. Because if I'm going to own this company, or at least control it, then I'm buying this company to get hold of the free cash flows. Dividends are irrelevant to me because if I control the company, I'll choose what dividends I pay out. On the other hand, if you are buying a minority shareholding, maybe you're just a retail, I don't know why I laughed at retail investors there, maybe you're just a retail investor, you've got a minority shareholding, all you will do is sit on the sidelines and receive dividends. If you want the present value of the returns you'll get from this company as a minority shareholder, well, the returns will be dividends. A dividend discount model will be appropriate. So don't overlook this early reading. There's quite a lot of nice little definitions in here which the examiner can get you to apply. To wrap it up, they're the key questions you need to ask yourself. Suitability of the model. The quality of the inputs means going back to our financial statement analysis material, which I know you will all enjoy, and be able to distinguish between your multiples in relative valuation and your present value models in absolute valuation.